Welcome to Keys Open Doors. Today we're breaking down daily market interest rates. You know, if you've been watching the news lately, you've probably seen a literal tidal wave of financial jargon. Percentage signs, economic updates flashing across the bottom of your screen. It's a lot. So in this explainer, we're going to take all that dense data and translate it into plain English.
Let's just dive right into it and start by asking a fundamental question. How do these dense, daily national numbers actually work? And more importantly, how do they affect everyday aspiring homebuyers? Because it can often feel like these macro-level percentages just exist in a complete vacuum, miles away from your personal bank account. But the reality? They are directly tied to your future purchasing power. To make sense of it all, think of this like your daily financial weather report. In general, these benchmarks act exactly like the weather. They broadly shape the overall cost of borrowing across the entire country. Just like a heavy storm affects how you plan your weekend, these national benchmarks dictate the climate for lenders. And eventually, well, that trickles down to exactly what you see when you apply for a loan. Short-term benchmarks, the cost of quick cash. To keep things incredibly simple here, a short-term rate is just the baseline cost for borrowing money over a really brief period, usually a few months or less. It's basically the rate at which major institutions move money around to handle their immediate day-to-day operations. Let's actually look at a real-world snapshot from May 2026 to see exactly where things stood. This specific data gives us a super clear, neutral picture of the borrowing climate at that exact moment in time. For example, during that period, the one-month borrowing benchmark was sitting at 3.66%. Now, obviously, you aren't going to go out and get a one-month mortgage unless, you're planning the fastest house flip in history. But this number is absolutely crucial because it represents the ground floor of borrowing costs. This specific number sets the tone for immediate, quick cash movement in the broader market. It's essentially the starting line. When the cost of quick one-month cash sits at 3.66%, it tells us exactly how tightly the market is gripping its money in the immediate present.
Section 2. The prime rate, the credit card foundation.
You probably hear this term thrown around all the time. We can translate prime rate simply as the foundation that major banks generally use to price consumer credit. It is a fundamental base rate used by the majority of top commercial banks to figure out exactly what they're going to charge you for borrowing their money on a consumer level.
Back in our May 2026 market data, this critical baseline sat at a very solid 6.75%.
Now, what's really interesting here is why this matters so much to you as a future homeowner. Many buyers watch this number closely because it acts as a massive anchor for things like credit cards and personal loans. When this rate sits at 6.75%, the interest on your revolving debt is priced right on top of that foundation. And remember, the more expensive your credit card debt is to maintain, well, the tighter your debt-to-income ratio becomes when you finally go to apply for a mortgage.
Section 3. Long-term yields. The marathon of borrowing.
In financial circles, you might hear the slightly intimidating term constant maturities. Honestly, don't let the jargon scare you off. This just means long-term borrowing benchmarks that are standardized across different timelines. It basically allows us to estimate the cost to borrow money over set numbers of years, even if a specific loan doesn't perfectly match that timeline.
By walking through this timeline on the table, starting from a one-month rate up to a 10-year rate, all the way to a 30-year rate, we can clearly visualize the progression of costs. We start down at 3.66% for 1 month, we climb up to 4.67% for 10 years, and finally reach 5.18% for 30 years.
And this brilliantly illustrates a core financial principle. Extending the length of a loan generally changes the cost of money. Lenders are tying up their capital for a much longer period, right? And they're dealing with way more unknown future weather. So the baseline cost naturally adjusts the further out you go.
Let's look a little closer at the middle of that journey. Notice how the 10-year benchmark sits right at 4.67%. This is a huge key figure that many financial experts watch to gauge broader economic trends. It's an incredibly important temperature check for the health and expectation of the long-term borrowing market. And more importantly, this is kind of the secret decoder ring for real estate, because everyday 30-year mortgage rates almost always track this exact 10-year benchmark.
Meanwhile, the 30-year benchmark reaches 5.18%. For anyone interested in real estate, 30 years is obviously a highly relevant timeline. This benchmark reflects the fundamental, underlying cost of borrowing capital over 3 full decades, which, as we know, is the traditional lifespan of a standard American home loan.
So the absolutely crucial point here is that ultimately, This upward curve, from 3.66% all the way up to 5.18%, shows us the market's long-term expectations. It tells us exactly how financial institutions are forecasting the financial weather over the next several decades.
Section 4. Your next steps using this information.
In general, it really helps to do 3 things. First, track the broader trend so you just aren't surprised by market shifts. Second, and honestly most importantly, focus heavily on building and protecting your personal credit. Your personal credit score is basically the umbrella that protects you from the rain. And finally, just understand the general market weather so you can make informed, really grounded decisions when the time is actually right for you.
Remember, the numbers we explored today in this explainer are broad, national benchmarks. Because everyone's financial weather is uniquely their own, you should absolutely always consult a licensed professional for guidance on your specific individual financial situation.
So now that you understand the actual data behind those flashy headlines, I'm going to leave you with this question. Are you ready to navigate your own financial weather and take control of your readiness?
Keys Open Doors, helping you unlock your path to homeownership. If this helped, like, comment, and subscribe.